Hi everybody, this is Gary Dean and this is our weekend video report for Sunday, February 5th, 2017. Hope you guys are having a fantastic weekend and let's get started. So one of the things that I was saying for quite some time was that we had a 50-50 shot of the S&P coming down and touching the 50-day moving average, which is right here, or coming up to close the gap. I didn't really have any bias to either side. I thought it would have been a little more helpful for the bulls to come down and touch it, so then people given have an excuse to buy. But they used the jobs numbers on Friday, which they're kind of average. I think they're just algorithms programmed to buy no matter what it was. But in any case, the 50% shot ended up coming up and closing the gap. Now, definitely went a little bit higher than I expected, but the overall wave count, and I'm just going to move to a 60-minute chart here, it hasn't changed. And yes, it would have been much better if this was the wave 5 here, because we had 1, 2, 3, and then there was an ABC wave 5 up here, 4, 5. And it would have made more sense if that was it and we were heading lower. Now, let's say the S&P is only 4 points away from this high here. Say they get it to 2307 or oh 05. This is just going to make the wave 5 here. It's just delaying the process of the move down. And there's a lot of things that are supporting that. And one of the main reasons is these bearish divergences on the daily chart, as well as the bearish pattern with the with the rising wedge here. So yes, they may head up, they may try to make new highs, but all that's going to do is make this wave 5 here, and it's really just prolonging the move down. So maybe the only thing they need to do is close this gap. And now they're going to come down and start closing some of the gaps that they left on the upside, or they're going to take their time with this. But their thing is, I would have liked to see them stop right at the 78% retracement. They're a little bit above it, and like I said, they're only 4 points away. One of the other things I've been saying is that it's the rate of change has stalled, and what that means is you can see this high right here where it took off. Then we came up, made another new high, but it was only some I think 10 points or 20 points above this. So you're not, now this one may be just 4 or 5 points above it. So what it is, it's one step back and then 2 steps forward to barely make a new high, and that's what really flattens out the rate of change, because you're not getting these monster moves anymore. You're getting volatility coming in, and obviously we've been seeing a lot of buyers at the 200-day moving average on the 60-minute chart. But once it makes a new high, or kind of a minor new high, it comes back down again. So this is the difference between when we started this move here, and it was just pretty much straight up with just little tiny pullbacks before we went higher. Now we're getting larger pullbacks, and this is all part of the topping process. And yeah, like I said, it's still, that 2301 may end up being the top, but the fact that they took it so high on Friday, now it's you got a 50-50 shot that they're going to make new highs. But as I said, it's really just delaying the process, because this is the wave 5. It either the wave 5 here is it, and we just closed the gap and now we're going to head down, or they're going to come up, make a minor new high, and then head back down again. But either way, there's still more points to the downside than the upside, and that's why I like the short side. So there's really not a whole lot to really go over. Now, the one reason why I'm saying that we still may be in this wave 5 here is, notice when we came down, we didn't even get to the 23% retracement. So that is, that's typically the 23% retracement is a minimum tracement where, it's just kind of going down, touching support, and then heading up. But the fact that we only got to the, to the 200-day moving average, and we missed this here, it's telling me there's still not a lot of fuel in the tank. And you can see that with momentum. When they only do a kind of a half of a fill of the tank, where this one kind of took its time down. You can see once we got to the midline, it exploded up and we made the wave 5. But when you come down like this, where it goes straight down, pretty much like we saw here, but only to the midline, it's stopping the fall. Just think of it as like a fuel tank, and you're using it, everything to stop it from going down, and now you're pushing it back up. you're using so much fuel and energy on this that it's tough to keep a sustained move, and that's why we're starting to see the volatility pick up. That's why we're starting to see sellers stepping in, and the wave count fits all of this as far as a topping process, and it frustrates everybody, and that's what I try to kind of give you a heads up on what I see. And it's more not predicting anything. It's more, okay, if this happens, this is what is taking place. And as long as we're trying to stay one step ahead of the next move, it's fine. And, knowing exactly where the top is or the bottoms, they're hard and they're not, that's why you always have to leave the door open for a plan B. And, this is the plan B. That was always to close the gap above before any meaningful move was to the downside. So they closed it and they went a little bit above it. Now it leaves the door open that we're just making an extended wave 5, but the bigger move is still to the downside. So I'm not really concerned. Yeah, it's frustrating. I would have loved for the thing to go straight down and not have any stress at all in the trade, but this is the market, and the market's going to do what it's going to do. So never even made it to the 23% retracement. If they do decide that they're going to make new highs, really what I'd be looking at is probably the next pivot, which is right at the 2307. So you can see it's only, this one was, I think, 15 points above the previous high. This one may only be 7 points above the previous high. And that's the rate of change in the topping pattern, where it frustrates the bears because they don't think the market's ever going to go down. The bulls are convinced that they're not going to go down, so they start buying every dip. And by the time we get to the top, everybody's, there's not enough people that are short, and there's too many people that are long, and that's what gives us the drastic moves. And it's been like this for quite some time, and I think that this year we're going to see a lot of these, but they're going to be even more extended than they are like this. I'm talking 100-point moves, 200-point moves up and down. That's going to happen really, really fast, and that's going to be the volatility that we're going to see. And like Woody Dorsey had said, in the thing, he goes with the President Trump, it's going to be, he's unpredictable, and that's what the markets are going to do. The markets pretty much follow what the lead office is doing, and for the last 8 years, the Obama administration was just kind of boring. It wasn't a whole lot of excitement, and the market was boring, and it just kind of grinded higher for 8 years with the Fed helping things out. But now we have an unpredictable president where people don't know what's going to happen or what's going to get tweeted. That's going to affect the stock market, and we're going to get these big, huge moves up and down, and it's fantastic for people that are looking to swing trade. But it's also, we have to remember that a topping is a topping process. We don't get the straight up, straight down moves. It always comes back up to test it, and really the lows are what happens as far as the V bottoms, and you have to keep an eye on those types of things. So let's just take a look at the 15-minute chart. I want to wrap this up so I don't keep you guys. Here's the resistance zone. Really starts from here where they were trying to hold it up to the previous highs. We're kind of a little bit above the midpoint here. So if they, pop it up again, we're probably looking at the 2307, and there's just going to be a lot of energy that was used, as well as a lot of gaps that are below that have not been filled yet. And it's, when you start building your foundation on gaps, it doesn't work. And it's one of the things where I think I pointed out where this gap right here, that it was going to fail. And from there, we went down. So this gap is not really the same as this because of this was on the way up that we got the gap up. This one was kind of on the way down and consolidating, so this doesn't count as far as like this one here. But I still think they're going to come down and close the gap, or even go lower than that, which I do believe, because I think the larger move is going to be to the downside. So right now, let's see what plays out. But as far as you can see, even on the 15-minute chart here, we got the gap up. This was the highest part of the price oscillator. So maybe we get a pop up to these levels here, and this causes the bearish divergences on the 15. We know that come on, why aren't you moving? Okay, so we know that we have them on the 60 already, and we already know that we have them on the daily. So it's still not, even though we had a great day for the bulls on Friday, they closed the gap. Doesn't make things any safer as far as for the market, and I would continue to look for shorting opportunities, and I do believe that the bigger move is going to be to the downside. So with that, enjoy the Super Bowl if you're going to watch it. I'm personally rooting for Atlanta because I just hate New England because they beat us all the time. But anyway, have a great weekend, and I'll talk to you guys in the morning.